Hi, everyone. Welcome to the post-Donald Trump election stock market update. You should have a pen and paper ready, and you'll want a video phone, well, a camera phone, just so you can take some of the screenshots of some of the stocks I'm going to cover. You should also be able to hear me loud and clear. You know the drill. There you go. Peter and Barry have already said it. They're from Pinner. Welcome. I've got a larger than usual crowd here for obvious reasons. It is the post-Trump era. And do you know what I'm going to do while I speak to you? I think we're going to go live on TikTok at the same time. Why ever not? So here we go. Weekly update as normal, but I'm also going to cover the US elections and what it means. And my God, it's turned out to be a lot better than I thought it would be. I didn't think, first of all, that the election would be this clear cut this quickly. Neither did a lot of people. And neither, as a result of that, did I think we'd have such a massive rally so quickly, because I actually thought it was going to drag out for a while. Whilst I did say, and I've said for a while now, Trump would win. You've seen that. I actually got, what the bit I got wrong was I thought Kamala would win the popular vote, but she didn't. But I did say Trump would win the Electoral College. Called it right a few years ago before as well. So it's nice to be right about it. So let's go. These are the things. There's the warnings. You're going to get a free copy of that book to download as well. If you've been on here before, you'll know that. So let's look at this. I showed this last week when I said I think Trump's going to win. And what I said is that the Trump presidency will be reflationary. What that means, bottom line, although this is from Schroders, is it means he's going to cause asset prices to rise, specifically stocks. And indeed, little did I expect there'd be an 800-point jump in Dow futures. If I did expect that, I would have bought a load of Dow futures yesterday and told you about it yesterday, wouldn't I? I didn't expect it to be that amazing a move in the markets. Okay, neither did the markets. Otherwise, they wouldn't have jumped 800 points. Do you get it? Do you get how it works? Okay, so it came as a surprise to the market as well. And so what we're really saying, what does this mean going forward? Well, it should mean that these rallies last longer for us and there's more money to be made for longer. Now, somebody said, can't hear you. Can you speak up? Can you all hear me quite clearly? I hope so. Yes, has a new mic. Haha. Well, it's not a new mic. It's the same mic. Can everyone hear me? Okay, just let me know that you can indeed hear me. I know they can on TikTok, but I'm talking about on YouTube Live. Oh, I see. That was a joke. Thanks, Jeff. Time and place. Jeff, read the room. Okay, S&P 500. Where are we on that one? 1 year without a 10% correction. Sorry, Jeff. We met in Spain, didn't we? You're all right. You can do it. 1 year without 10% correction. This is ridiculous. In hindsight, of course, a great opportunity to make lots of money. But if you look back over the past year, were there many moments where we felt, wow, this is just ridiculously great? No, there were moments where, in the words of Warren Buffett, you wouldn't jump in with both feet with the markets. You'd sort of toe dip, keep in, maybe dollar cost average even, which is fine. But it's a useful reminder that even when you're making money, it's rare that it's, oh, this is so easy. This is just too simple. Okay. It was the fact that you get these sharp jumps. What's been great in hindsight is, well, we've not had a year with that 10% correction. I didn't realize that until I saw this. That's probably going to continue for a little while longer. And I'll show you just exactly what a great year it's been. I think with Trump now, certainly in the near term, it looks like this will continue a bit further. And it did when Trump won for first time round. S&P 500 seasonality on top of this, regardless of Trump, November to December is on average a great period for stocks anyway. Okay. And on average, the source of this is Goldman Sachs. All right. Now, I'll give you the same warning. Past performance is not a guarantee of future returns. All right. So keep calm. So you've got a few tailwinds greater than I thought. I honestly did not think this election was going to be sorted by, I was up all night. So what, by about 5 a.m. UK time, midnight US time, when Hawaiian polls closed, it was, this is done. Maybe even 4 a.m. I did not think. And I think that certainty the market wasn't expecting. And that's all led to the sort of everyone being crazy happy. Sylvain says Bitcoin all-time record. Absolutely. Well, if you remember, Sylvain, we've been pointing to the ETFs on Bitcoin saying, oh, keep going up, keep going up. Perhaps I should have done more than just point out to them. Josh, I'll answer that question a little bit later. Thank you, Paresh. Yeah, Paresh is on. Great. Thanks, Paresh. So Paresh is on as well. Little thing about Paresh, you might not know. He produced all the trading strategies for a multi-billion-dollar hedge fund called Marble Bar. All the initial trading strategies came from him, and they're in one of our books that he and I have co-authored. He always jokes to me, he goes, people, I think I'm your bag carrier. Do they know my credentials? And I said, look, mate, I promise I'll let people know. S&P 500 seasonality, as I said, November to December is always great. For those of you who happen to be on TikTok, you might want to switch to YouTube where it's a lot clearer, which is, sorry, not YouTube, to the webinar, which is alpeshpatel.com/latest shares. Now, one of the reasons why this whole Trump thing is so important, the US election is so important, and what's just happened in the UK with the budget is so important, is I think it's going to make this trend, I'm going to explain what's on screen in a second, continue. What you're seeing on screen is that's the NASDAQ, that's the S&P, that's over a number of years, that's the UK. I think the UK is going to continue being a laggard. I don't think the budget is going to have helped change anything. In other words, it'll continue. So that's good news if you like same old poor performance. I think the US is going to, well, I'm going to look at the data. I'm going to be led by that. So if I forget the data and take my data hat off for a second, I think the US is going to absolutely explode to the upside. I think it's going to be volatile, though. Look who's in the bloody White House. What do you reckon? The first impeachment articles are presented to Congress or presented by Congress in year 3 or year 4. Won't happen in years 1 or 2 because it looks like the House is going to be Republican and so is the Senate. So I reckon 2 years in, the House goes Democrat again. Articles of impeachment are sent to the Senate for prosecution. Senate obviously say, nah, forget it, for conviction rather. And they say, no, same old crap. That all aside, what I think will definitely happen is it's going to reconfirm what I've always said is I'd rather be in these two than in this. All right? Especially given that he's going to be deregulating. He's probably going to deregulate cryptocurrency. How do I know? Flipping Elon Musk and Dogecoin. Elon Musk is going to become a trillionaire if he's not already. I guarantee you in the next 4 years, Musk will be a trillionaire off the back of unregulated, deregulated Dogecoins, and Tesla's already jumped up, and we'll look at that. Those two billionaire boys, Trump and Musk, are going to make an absolute killing. That's the way they do it in the West. In front of your face. Right, so where are we? I mean, anything Musk wants, he's going to get. All that regulatory crap, out of the way. All right? You want rockets to go up from central New York, we'll make it happen. Central Park, as a launch pad site, that's going to happen. All right? Whatever he wants is going to happen. And there's no other billionaire who gets that level of access because all the others decided to be on the blue side. Right? So, I'm not saying this is good or bad. I'm just telling you how I'm reading it. Okay, so for me, sadly, because I'm not best chums with Trump, it's the S&P and the NASDAQ and the individual stocks that are going to be the way to make money. And you might say, oh, this is disgusting, talking about making money when look at the social issues and problems. I know, I'm focusing on this part. Right, even more so because this isn't going to change. The British pension funds are going to continue, I guarantee you, being really bad performers, especially against their benchmarks, because some of their benchmarks are going to have more exposure to global. These funds are going to continue being piss poor performers. I guarantee you that. So I'm afraid British pensioners, beyond the fact that they're now, because of the UK budget, paying some of them 67% tax on their pensions if they're over 75, higher rate taxpayer, giving it to non-spouse, i.e. their children, that's going to be 67% maximum tax they're going to pay. Their pension's just been decimated, basically. On top of that, they're going to get piss poor performance. So my saving grace is I'm going to continue doing what I've always done. SIP, ISA goes into individual US stocks. And for those, what about currency risk? Yeah, you messed up again because the dollar's just appreciated and it can buy more pounds now. Actually, the biggest one-day rise in 8 years just happened today. Stop messing it up. Stop punching yourself in the face or letting these guys punch you in the face. That's going to continue. What's also going to continue under Trump and be even more pronounced is that's going to be your average pension fund. Time it takes to double money. 5% return is what your average pension fund's going to do because they're just not going to invest in those outliers. They're going to be shit scared to invest in those American companies, which are going to skyrocket. And what they're going to say is, oh no, too volatile, let's not do it. Let's just put it into some mining company on the FTSE 100. And so you're going to get a load of Brits getting 14 years to double their money in their pension at 5% returns, which is what your IFA or wealth manager will tell you is what you should look for. And the rest of us are going to go closer to an S&P return and get 15% and therefore double our money in 5 years, preferably 3.8 years at a 20% return. Okay, that is more likely now than ever under what's just happened yesterday. And he's got a mandate. This time he has got, I mean, forget all the not my president stuff. If you take the Senate, the House, and the presidency, does anybody remember when the last time that happened? Bush? Okay. And they're only going to have it for 2 years. They'll have the House for 2 years, and then they'll lose it to the Democrats in 2 years at the next election for the House. By the way, don't forget YouTube. You've got 100,000 on there, so do sign up to that. Now, I'm going to start off with specific stocks. I know you've got loads of questions. I will answer them as we go on. Okay. Actually, you haven't. That's great. And I want to ask you something else. Okay, I'm going to ask you the stupidest question ever, which is, will the Dow be higher by the end of the year? I think it's, what is it, up some gazillion points today? I'm going to take this, okay? I'm going to take this as my approach. I have no opinion on any stocks. The computer has its opinions, and we slavishly follow them. Now, that's his view. I got an email from a client today, yesterday, saying, hey, why don't you give us more of your opinions? Spend more time. Well, do you watch my broadcast? We use the computer because it avoids loads of cognitive biases. So this is the computer. None of these, for instance, which go into my database, meet my criteria because they're not all green across value, growth, income, cash return, capital invested, Sortino alpha. So see these, I'm going to scroll down. None of these are good enough to make my football team or my university entrance or get a Nobel Prize. That's how strict the entrance criteria are. The computer has its opinion. We know that undervalued companies, because what we're looking for, perform better than overvalued ones. We know growing ones do better than non-growing ones. We know ones with momentum and high average returns with low downside volatility tend to do better than ones which don't have momentum, which are going in the wrong direction, which have low average returns and deep drawdowns. We know ones generating lots of cash based on the capital expenditure that they invest in their companies tend to do better than ones that don't. We know that from Goldman Sachs Wealth Management Quantum Division's research. So that's why we want all greens and we want to avoid those. Now, it doesn't mean that some of those outside there might not suddenly win the lottery and do well. But none of these are good enough to be in my pension. And I won't show you anything which I don't think is good enough to show my family. In other words, put in my son's junior ISA or my wife's SIP or my own. Okay? If I won't put it in front of my family, I won't put it in front of you for obvious reasons. Why would I? Okay? So I'm going to put that to one side. We're going to come to stocks. And I just want to let you know, sort of at the top level, that's the way in which I look at things. So that's valuations. Again, we know everything's expensive and it's going to get more expensive under Trump in the near term because prices are going up because there's a lot of momentum in the market now. There's been trillions on the sidelines waiting to get in. That's why the dollar's gone up, because even foreign money has been buying dollars, okay, as well as traders bidding up the dollar because they're just more confident about the US market. That'll ease off a little bit possibly because Trump is going to try and pressure the Federal Reserve to lower interest rates. They're not going to do it because he's going to reduce corporation tax. He's going to spend like crazy. Those are inflationary aspects. Therefore, US interest rates will stay higher for longer. Okay, which means if your interest rate's high, what happens? People want to hold your currency. Put it in a bank account, get higher rates of interest. So what happens? Your currency goes higher or stays higher for longer. So the dollar will probably continue edging higher and appreciate more. Anyway, the point of that is nothing more than for me to say that whilst these all look expensive and the reds are going to continue, valuation of a company is not the only measure of what will move stock prices. Because if it was, all those reds like Microsoft, Nvidia, Apple, Amazon, Tesla would not be shooting through the roof. Growth, prospects of growth, growth forecasts, dividend deals, cash returns, these other factors are important. However, as you know, I have JP Morgan stock. It is relatively undervalued and has been skyrocketing today, for instance. So some of these should continue to do well. And if we do find any in these which meet our other criteria, then all well and good. We would rather have them. But as I've already shown, this is what I look for. Okay, value, growth, income, cash flow, cash return on capital invested, momentum, Sortino, alpha, high average returns. And now me looking at the Sortino is me cheating. And it comes from the hedge fund industry. I set up my fund in 2004. By the way, for those who don't know, some of you might not know who are on TikTok at the moment watching this live, you can download a free copy of that from alpeshpatel.com/links. I'm looking at that. That's one of my books, which incidentally, if you happen to be Korean, you can also get my book's been translated to 8 languages. That's the Financial Times Korean edition of the book. Okay, where's the camera? There it is. The Financial Times Korean edition of my book. There we go. Who cares about that bit? What you really care about is there's about 18 published. So I'm giving you this not just because I've suddenly come up with it. That's one of my international bestsellers. Again, ft.com with the publishers. Financial Times are the publishers of that. That's a really heavy one. Is that? Ugh. The point being, there's a lot of education information in there, which I've written about. Sadly, none of those 3 were co-authored with Paresh. The ones which are co-authored with Paresh, it says his name on it, and they came later. But the point is that this information and data is not based upon me waking up one morning. It is based upon the research that we got from the likes of Daniel Kahneman, Richard Thaler, Eugene Fama, 3 people who went on to win the Nobel Prize in Economics, who I lectured about when I was a fellow at Oxford University, and also who I've written about in my Financial Times columns and in the book. So just to give you a bit of sort of background to that, some of you know this, apologies. Okay, but the Sortino, for instance, let's focus on that this week, and I'll look at the Croaky next week and other ones in different weeks. It's a cheat. It's me cheating. It comes from the hedge fund industry because it's the average return versus the downside risk of missing it. Now, UK fund managers don't know what that is. Hedge fund managers do because they're like clever. Retail fund managers, the type that Hargreaves Lansdown promote or St. James's Place promote, have no bloody clue, let alone IFAs who really have no clue. I mean, come on, if you're sitting an exam based on multiple choice, you know, and you can still get 30% of the questions wrong and pass, come on, you're not exactly, you know, going to set the world on fire, are you? So the Sortino, you want really to be below a baseline minimum. Okay, it's not physics, so it's not as if higher the number guaranteed to win. Otherwise, you just pick one stock, wouldn't you? So that's what we want to do. And we want those green. I make my life very simple. If it's green, then it meets all the criteria. Oh, by the way, that's blurred because this is an old document. Otherwise, somebody would think this is up to date and go and buy a load of those, right? So there's very few companies that will meet the stringent criteria. And you want it like that. All companies are collections of individuals who have CVs to basically what they're saying is, I want to manage your child's inheritance or your old age pension. That's what companies are. They're factories for making money of individuals who have CVs. And if they have CVs, you want to look through 10,000 of those and narrow it down to the best 20 because you're managing your own investment company for your family. You are the CEO of your family's future. And if that's the case, then I come along, pretend I'm Goldman Sachs or McKinsey, and I come along and I say, hey, listen, these are the ones that we want to present to you as the shortlist, and this is why. Okay, and you need to understand why, because it's your money, right? And that's the attitude you should have, not, well, I heard something in a pub once. Over the past year, these are the performances. Aren't these bloody amazing? I mean, over the past year, even Tesla's up over the past year. It was shot up today, but we'll come to that a little bit later. Past year, that's what it is. Let me actually pull that up because that is really the biggest winner from, I mean, if you're a billionaire and you listen, the media story that Elon's putting out there is, he's not doing it openly, is he won it for Trump. And if he hadn't come out batting for Trump, Trump might not have got it, let alone the fact that he did it through Twitter. That Twitter purchase looks a bit cheap now, doesn't it? Because it allowed Trump to go broadcast through there as much as he wanted. And Yeah, anyway. So I'm going to show Tesla in a second. Well, actually, let me do that now. I'll have to check whether it's a 7, 8, or 9 on my special situations. It was earlier in the year when it had crossed through here. So what you're really looking at is for this to just now, and it's oversold. That just does this, whoops, which means this little baby does that. And you're looking, I'm happy to say 200% over the next 12 months is what we're looking at. Okay, if I tone it down a bit, I would say worst case 72%, okay, from there, because it'll get to the all-time high in if I tone it down, something like that. If you wanted to make it into an investment, and this is not a solicitation of investment, your stop loss could be there, could be there. The reason you have a stop loss is just in case, who knows, the bottom falls out. I don't know, Trump, I don't think I can say this in a broadcast, something happens to Trump, you know, that kind of thing. You know, one night, celebrating with Melania, you know, back in the old home, heart attack, all of a sudden, you know, Elon's not good friends, whatever. So that could be a stop. Make sure that if it hits your stop, you don't lose more than 1% of your portfolio. That's how you decide how much money to put in. If you put more than 1%, it's your risk, at least you know. But yeah, that's how it's starting to look more and more with Tesla, let alone some of these, okay? I mean, that's a lot of green. My job for my clients is to make sure they've got the opportunity, they know how, they know why, they know how to analyze these, they've got the data on these, they've got my view on these, but they've got the data. Is it value growth income? Is it Sortino? Is it alpha? What's the chart on all of these? So that should there be a tailwind, this is the past year, they get to benefit from it. If there isn't, and this is past year, it is not past 8 months or 6 months or 7 months. I don't judge it over 6, 7 months, because I'll give you a classic example. Why not? Microsoft 2021, 9 out of 12 months in aggregate, 9 out of 12 months, it was either 0% return or negative returns. In that year, in that 12 months of 2021, it actually ended up 50% up. So when people go, oh, it's been a month and I haven't got my return, and I say Valium or cannabis, take your pick, but relax, you're going to give yourself a heart attack. And there'll be other opportunities as well. And even in my best year, there'll be stocks which have gone down. Even in this, there will always be, and it's sod's law, because sometimes it's the ones with the highest, you know, they're packing a punch and all the rest of it, and then CVS drops, bugger, Elevance drops, okay? Even out of all of these greens, you could have that, and that's fine. In fact, the ones which show the reds can sometimes, I mean, we never had Nike, for instance, or most of these you miss, but they can sometimes have the same characteristics in that high growth, relatively undervaluation, and they miss it by a short margin and they drop, okay? Because they're high performance. They're running in the Premiership. They get punished hard. They're playing with the big boys. They're being compared to the big boys. We're not looking for rubbish companies and turnaround situations. And that's why sometimes, even when you're looking for these big ones, you end up with 1 or 2 which don't quite do the mark. Anyway, JP Morgan, for instance, has been phenomenal. Anyway, I'm going to go through this. Don't forget to do all of this. All right. Those TikTokers, I'm on alpeshpatel.com/links. /latest shares if you want to watch the webinar on your computer or phone or whatever. The past week alone, and this is post, if I'm not mistaken. This is post the election. So this is wet. The ink on this is wet. All right. And Tesla had a big lump today, which made up for some of the past week's falls. Don't read too much into the past week because it's not really that important. The past year, that's 14. That's 29. This is the past year yesterday, is what it looked like. This is the past year today, i.e. in one day, look at that jump up. Okay, past year, not for all of them, that's 16.63 and that's still 16.7. It's really this one, which is a big one. Sorry, sort of confuses you, doesn't it? All of that. That was the big change over the past year. What's happened is that's been one day, 15% up or something. All right, look at that. It's just ridiculous. He will deregulate. He will Energy companies will have to see what happens, because I think there's going to be deregulation there. They're going to start mining in Alaska. Environment, forget about it. Global warming, couldn't give a shit. They're going to be digging for oil, digging for coal, bringing back coal. Carbon emissions, forget it. That's for somebody else. So they're going to go in a massive dash for growth, and they're going to use a lot of debt. Okay? If you've got moral qualms about profiting from an economy run by a person who's going to do that, then, hey, I get it. Sorry, switch off now, I'm afraid. But I'm being amoral, some would say immoral, on this. I'm just telling you what's going to happen and which stocks are going to do well off the back of it, which at the moment looks like all of them. Markets over the past year, and this is after the Trump victory, well, the Nasdaq's now up 36% over the past year. Okay, now for those of you who might only have got into the markets in, say, February, you have had a frustrating period because you've had long periods of 0% returns, massively long periods of 0% returns. Okay, and that sometimes happens. One of the best ways to avoid that kind of FOMO of thinking, oh, I'm lagging behind, is buy the index. Okay, buy the index and buy what I call my quality 5. My quality 5, which I've always bang on about, the 2Ms and 3As, and every single week I cover them in this. The 2Ms and the 3As, Meta, Microsoft, Apple, Amazon, Alphabet, and I cover them each week anyway. And in any event, they're the ones which were the ones behind the index rising. So if you had the index, as I do, and as you know, because I mention it every week, and you had the quality 5, as I do, because I mention it every bloody week, then you would know, and I'm putting leverage to one side, then you wouldn't have the FOMO. But if you're doing individual stock picks, then, of course, you might have had periods where you've had long 0% returns. And don't forget, markets can fall. So this is not a straight line. That looks easy. But we're looking at that in hindsight. That was a bloody tough struggle. We didn't know it was going to do 36% this year. If you'd asked me at the start of the year, I don't think so. Because if you watch these broadcasts, you know, every week I go, well, looks okay, seems fine. It's never been, wow, this is just fill your boots. I mean, the closest I've got to fill your boots, this is positive, it's probably today. To be honest, well, you can tell from my tone. Go back over the previous weeks. It's been, yeah, I'm still holding my index, or I'm still holding Microsoft, or I'm still holding Apple. Looks a bit wobbly. It's never been, wow, this is too easy at any point. I mean, I've said, look, Goldman Sachs, yeah, it's doing well, great. We're going to hold on to it. JP Morgan, yeah, it's looking great. We'll hold on to it. It's never been, whoa, this is just, wow, hallelujah. It's not been like that. Today's one of those rare days. Because, bloody hell, 800 points up on the Dow, it would be one of those rare days, wouldn't it? So, yeah, and it's probably days like this which boost your pension up anyway and make it go crazy. So that's where we are on that one. ETFs over the past month, well, as I kept saying, you know, the cryptos are doing well. I've not looked into them beyond just showing you this chart, all right? So I might do a separate one on crypto and crypto ETFs and Bitcoin if you wish. But I haven't done one yet. Okay, and I can. And I'll do a separate one on ETFs. Generally, I haven't done one yet. You can pause and look at that if you wish. Well, on the recording. Now, what I really want to show you, and this, Trump makes this more likely than ever. It's events like what just Trump has done and Musk saying this is going to be amazing for the economy. I mean, do not underestimate the power of Elon Musk's tweets today, where he's showing his rocket taking off. He actually built that bloody rocket. It's not some AI image, and saying this is America taking off. Now, I know what you're going to say. You're going to say, bloody Americans, they're crazy. If you're British, you'll probably say that. You say, how distasteful. Such a display of emotion. For goodness sake, one should have a stiff upper lip and keep it indoors. However, if you're American, you might also say, it feels a bit like what the British felt after Brexit, where the Brexiters were like, woohoo, we're going to be unleashed, blah, blah, blah. The thing is, when a trillionaire, Musk, shows a rocket taking off and saying, we're going to be unleashed, it's not exactly the same caliber as a Nigel Farage saying it, is it? So I'm inclined to believe the Americans when they say it, not least because more than 51% of them voted for this, etc. So I think they'll deliver on it. Especially because legislation's in their favor and they've got a business leader of the caliber of Musk on it, okay? So anyway, what that means is this is more likely than bloody ever in the next 2 years, which is what I'm looking at here is average positive return, 32%. Okay, so in the next 2 years, I'm going to say, I think we're going to get another 32% over 2 years. Not over 1 year. I'm not going to say 1 year because that really is Who knows? But over the next 2 years, and I think there's an 88.5% chance that's going to happen, because I think we're going to really hit the sweet spot of this now. Okay. I don't think we're going to get that worst return or average negative return. And anyway, my job is to keep an eye out for it, which means a daddy bear. And if I do, then we want to cut out some of the big losses. My job is to cut out the big losses. It's this: let the winners run, let the winning years stand by. And you'll see each week I go, yeah, I'm just waiting for that. I don't say, oh, let's get out of this. Oh, let's get back in. Let's get out. Let's get back in. I just say, well, let's just wait. It's another day of waiting, another week, got another broadcast. So that's what I'm looking at. I'm looking for my pension at least to go up 32% in the next 2 years. That's excluding leverage. Now, as some of you know, I have 2 times leverage ETFs on Microsoft, Apple, Amazon, Alphabet, not Meta, because I got rid of that in April to rebalance because it was just such a big portion of the portfolio. And there's obviously the S&P 500 and the NASDAQ tracker. When I say mine, it could be my son's. I'm calling my family sort of collectively on this, okay? Including the family collectively. So that's excluding that. I'm expecting that. Not guaranteed, not certain, but I said this last when Trump won the first time. And it's on a Twitter somewhere. And I think I CC'd Sally Bundock from BBC on it. Anyway, this was a nice testimonial. It all depends. In 12 months, you've got to look at it over 12 months. I've seen a 30% increase in my portfolio. That's from Trevor Atkin. Thank you, Trevor. It's amazing for me and my family. I cannot thank you enough, Alpesh, for providing the information. Good. That's the goal. Okay. If you want to see more case studies and videos, these are videos with people, not just quotes, videos and case studies. Have a look at that website, alpeshpatel.reviews.com. Let's look at the S&P 500 and where we are on it. So questions, I know there's a few more. I will do this. I will answer your questions, everyone. Yeah, Paresh, thank you for that. Yeah, I think it's a 4 on the VGI just because it's just ridiculously priced to earnings. The valuation is what's dragging it low. Growth, I don't think is. I think it's valuation, but I've given a non-GIP investment version on it, investment going forward on it, strategy. S&P 500. So my original worry was we are here, okay, like here, and it could be a daddy bear, all right, which means that could happen, right? So that could happen. Now I'm thinking, let's see what happens when I do my Friday broadcast and next Wednesdays. Is this going to just continue going higher? All right. Is it going to fuel it? We don't know. We don't know. That is the absolute best case scenario, which the probability of which has just increased more. I'd rather still say 32% over 2 years. That's what I'd rather say rather than 42 over 1. Okay. Obviously, it's a bigger, wider goal. It's like, can you score in those goals? Well, can you move the goalposts a bit wider? Yeah, because I'd rather do that. It's a difficult profession. So I think that, but we'll look at this each week. That's why I do my broadcasts on Wednesdays, and I do it for my clients on Fridays, and then Wednesdays and Fridays, Wednesdays and Fridays. So, keep an eye out. But I think the probability of that side has just increased. So I'm a bit more happy and comfortable today. Same with the NASDAQ. Okay. I think it's increased a bit more. We're still going to be vigilant. I'm not taking anything for granted. I'm not just putting my feet up and saying, it's all fine. It doesn't matter. Okay. The UK market, yeah, if you bothered, well, the danger is that's going to fall below its moving average like it did there, and this just goes sideways for a while. I think the biggest drag on the UK economy, and not just the FTSE 100, is 25% corporation tax. It was 19. By the way, Trump said he's going to reduce corporation tax in the US. I mean, John Maynard Keynes, the famous economist, British economist, has said that animal spirits is the X factor in the economy that you can't measure for. Animal spirits. And that's what made the man a genius, because he was more than happy to say there are certain things I can't put into a spreadsheet, basically. They didn't have spreadsheets then, I don't think. Okay. Animal spirits is what he called it. Animal spirits have just been unleashed in America. Not for all of America, don't get me wrong. There's a whole bunch, from a social perspective, minorities of every kind who are not having their animal spirits unleashed. But there's a whole other bunch who, let's put it this way, they're bloody ecstatic. There's a lady today on the BBC, I think she's from Venezuela, and an immigrant from Venezuela. And she said, look, I just want to work hard, get ahead. I'm glad Trump won. And I'm just so happy we're going to celebrate. The difference being, after the UK election, if a socialist is doing that, that's not really going to add to economic growth. And you certainly didn't have the non-socialists doing it. So you can see the impact and the difference. You're talking about somebody who at the bottom of the ladder is entrepreneurial and wanting to get up and go. And that's why I'm saying it's going to make a bigger difference, and that gap between the UK FTSE 100 and the US markets is going to grow bigger. That doesn't make me unpatriotic, because I'm British and I spend my money in Britain. If I own American assets and they're working for me, Apple's working for me and making me money, and I bring it here and then spend it in Lidl or Poundland, then it's British economy which is working. In fact, I want more people in Britain to do that and bring American growth and money over here through their pensions, ISA, SIPs, because they're going to get taxed till it hurts. Fine. Okay? If you're already American, I think, Kashif, you're American, then you're laughing, my friend. You are absolutely bloody laughing already. Top 10 S&P 500. By the way, you know, I think I've said it often enough. My first column in the Financial Times, 1999, 25 years ago, quarter of a century ago, first column in the FT, first paragraph, I'm selling all my UK stocks, and I'll show you that later anyway. Top 10 S&P stocks over the past month. This sort of goes out of the window, really, because, and we'll look at some of these to see if any of these are interesting, some of the big movers. Let's look at some of those. Paycom, 8 on my value growth income, so relatively undervalued, good growth. The banks are just not particularly liking it, but it tends to go up more months than it goes down over the last 10 years. That's the absolute most optimistic upside. Most upside, that's that. You'd probably put a stop loss maybe there for it. I'm expecting it to do this. It could even be a special situation on my Great Investments program. So you'd put that as a 25% stop loss or a stop loss there, whichever you prefer. And yeah, so that's been one of the big movers recently, and it fits the profile. Palantir as well. That'd be the projection there, but it's overbought. So the problem I've got with this is it's overbought. That'd be your projection. This wouldn't fit into my program as things stand. I think if you wanted to take the risk on it and you think it's going to go in that trend and give 100% in the last 12 months, if you think that, on your head be it, because it's overbought there. But if you did, what I would say to you on a risk management basis, if you came to me at my desk and said, Alpesh, I really want to do this, boss, what do you reckon? I'd say, look, if you want to do it on your head, it's your bonus, but put your stop loss there and make sure you don't lose more than 1% of your total capital if it drops to there. Hold for 12 months and look for that return. If you get it wrong, I'm going to smack you, is what I'd say to you. All right. Dayforce was one of the other big moves in the S&P over the past month. That's the most optimistic bullish projection, and you'd look for that to move up. It's not a special situation in my program because it's not 7, 8, 9. However, that's the structure. If you said to me, boss, I've got an idea, I want to do this, and I'd say, right, there it is, and your stop loss would be there. So you've got multiple upside to downside, and don't lose more than 1% if it drops to there. And you get punched in the face if you're wrong. Okay, sorry, it's a little company rule we have. You get punched in the face if you're wrong. GE Vernova, 100% would be that, and that's really benefited. It's considered one of the top trades, actually, and you can see why. It's a spin out from General Electric. General Electric are probably going to spin out more of their companies because they're making an absolute bloody killing when they spin them out, and I suspect they're going to just float part of the capital in future. Yeah, they like it. I guess you'd put a stop around here-ish just in case, or a trailing, you know, whatever that volume is there, whatever that size is, you put it from below there to here, and there's your direction. Okay, doesn't quite fall into the program because the program is really focused on more like medium risk pension stuff, but I do give these in the program as a thing outside of it, if you see what I mean, out of the Great Investment Program. So it's not 7, 8, or 9. That's why it can't be a special situation. Don't forget, if you want to open SIPs and ISAs, it doesn't have to be Barclays. That's just an example. It is so simple. You go online, you put your details in, they're pensions, or in the case of ISAs, they're tax-free wrappers. They're both tax-free wrappers. Okay, so any growth in there is tax-free. Now, why is that important to me? Well, if you're getting bloody 32% gains, I do not want to be paying capital gains tax on all of that. Okay, that's why. And I appreciate that the government wants to take off as a wealth tax and a death tax 67% of my pension eventually one day, on the basis that they're going to give me a Ozempic so I live over 75 years, and that allows them to tax me more than if I lived under 75. That's why they're going to give me a Ozempic. Okay. Keep me alive, probably on a resuscitation machine, and then take all my money. That's fine, but that's how you open it. It's really simple if you haven't done it already. And there's many brokers. These are just some of them. I've got accounts with all of them and more because that's what I do. The reason I do it is because I've been in that bad habit since, well, not bad habit, rather good habit, I guess, since I wrote that book. Can you see that? Just make sure you can all see me. There you go. I hope you can all see me as well. Tools, Dave, I can use. Dave, I try and always, since I wrote this book, actually, since I wrote Trading Online, and I covered loads of websites in it, the sites I've always tried to give people are ones which are hopefully free, so they don't have to pay subscriptions. I'm always scouring the website for them. So you could use TrendSpider or TradingView, for instance. They're free. Yahoo tends to be free as well. So you can use any of those sites for charts. Okay, I always try and give you free stuff if I can. Now, before we go back onto some of those stocks, let's just have a look at this. Pensions lost a fifth of its value. This is what's happening in the UK. I'm talking about Trump and these gains and these big companies, and these buggers who are managing your pension are losing a fifth of its value in your workplace retirement plan. Okay, give workers power to ditch pension schemes. UK regulator, right? Pensions, why do those retiring face massive losses despite FTSE highs? Well, because pensions in the UK generally, so often, could legitimately be called a bloody scam where fund managers are shoving it into shit companies, getting piss poor returns, okay, because they've been given a remit only put into those mining companies or something in Vietnam or emerging markets. And they're like, I guess they're like the moronic person who's been told, look, this is where the money's being made. And they're saying, yeah, I don't want to make it in that. I'm gonna go put it somewhere else. Can you find me something else instead? Okay, have British fund managers become a pointless expense for investors? That's the Telegraph. Worst fund managers take £500 million in fees from investors. That's also the Telegraph. Okay, I mean, and these fund managers are in pensions. By the way, on YouTube, on my YouTube channel, alpeshpatel.com/links, you'll find it there. I do cover various really bad specific pensions, which, you know, people write into me and say, look, my workplace pension is invested in this. What do you think? Or it's invested in this. What do you think? And so on. So have a look at all of that. Doubt 91% you think it'd be even higher. Well, there you go. That's the highest I think any of you have ever said. Let me put it this way. Speaking of crappy IFAs and fund managers, and I've been on a mission. I mean, look, I've written about it. I've lectured about it there. I've written about it in 18 books and in 200 Financial Times columns. And I've been on a mission to tell people these fund managers are pretty shit. Eugene Fama got the Nobel Prize in Economics for pointing out fund managers are really rubbish. So let's have a look at more of the market update. That's the most optimistic trend forward. If it were to continue forward, that's overbought is the concern. Okay, but if you did want to do some kind of investment structuring, you'd probably put a stop there. Okay, so you've got multiple up to downside, and that's where the stop is. Now, Apple, I'm going to leave analysis of this for my Great Investments Program clients because otherwise they get annoyed. So for those who are on the Great Investments Program, would I buy more? Would I buy, hold, or sell? Well, I wouldn't sell. Would I buy more? Would I continue holding? Well, I'm continuing to hold for sure. Would I buy more? I'll let you know. I'll do this one for the clients. Same with Amazon. I'll do the one for the clients. Microsoft, I'll do the one for the clients. Yeah, I know. My wife sometimes says, you get paid the big bucks for telling people about Microsoft. Because, you know, she looks at this and she goes, seriously, you're taking credit for Microsoft? I said, listen, what can I say? Sometimes it's bloody easy, you know, and people won't look at the big fat elephant in the room because they want to look for mice running around between its feet. So Meta, I'll cover in the Great Investment. Now, I got out of this in April because it was in my son's, both the leverage and the unleveraged. And the reason for it was not because of anything other than to make the point that when you've had it since last January, it had gone up so much that even the smallest move was meaning he was losing thousands if it went down, say, 0.5%, because we'd had it since since then, basically, and it had gone up from whatever 100 to 572. Well, no, by April about 450, so for 4.5 times, and the double leverage even more. So I'd got out of this out of one of the but probably what I should have done. It's not got out of it, but just reduced all the tech companies equally. But I thought it's just easier to sell one than sell a bit of everything else. Okay, so that's Meta. Like I said, YouTube, there's a ton of my stuff on there. There's more stocks coming. Don't worry, we haven't finished. Where I also go through, you'll see my BBC interviews. That's on oil prices. By the way, oil should drop in price. Contrary to what people are thinking, Trump is not going to start a war in the Middle East. What he's going to do is going to call up Saudi Arabia and he's going to say, this is not a political point. He's going to say, Israel are going to get this deal. The Palestinians are going to get screwed. And you guys aren't going to do anything about it because you don't want a conflict either. And I'm afraid that's what's going to happen, although it should mean the bombs stop and more children don't lose their lives on both sides of the conflict, disproportionately on one side more than the other at the moment, but that's neither here nor there. I don't care what religion they are whether they're kids or adults. But the point is, I don't think he's going to be a warmonger, and he's going to be a strong, erratic president, which game theory tells you is what you want if you want to stop other people pissing around with you. Joe Biden was easy. Hey, Sleepy Joe, let's go. Let's the Taliban run into Afghanistan, Russia into Ukraine, etc. I suspect he will do a deal to stop the war in Ukraine, which I suspect the Ukrainians will not be happy with, I'm afraid. And I don't think that's a surprise. But what I'm saying is all of those factors should mean oil prices drop. That's what should happen. Okay, that's more a macroeconomic. It's not a trade thing I'm suggesting. Don't forget, I've got these new things that have come out. I give the 40% ETFs. There's very few of those at the moment, but there are one or two exchange traded funds going up at 40%. Hedge funds, which are producing 40% returns per annum for the last 3 years, and which stocks meet my criteria that they have, I do that now. Banks. So keep an eye on YouTube and TikTok. My private clients get the full thing, but I drip feed some of these in the public domain now and again on TikTok or YouTube, one or two. Which big banks have given their buy recommendations and what they are, and also intermediate term investments as well, based on 40% to the upside, 20% to the downside. Okay, so 40% is the magic number that we're looking for. Can we get a realistic projection of 40? Can we do a stop loss at 20? So we've got multiple up to downside. And can we make sure that we don't risk losing more than 1% of the portfolio if it drops in? We're looking at 12-month period, other than for those where we're looking at 6-month periods. Okay, so I won't read all of this to you. I've told you about this before. This is with the exchange trade funds. They tend to be smoother. Funds tend to move a lot smoother than individual stocks. And I'm starting to think there's more people than I thought who should be looking at funds. I used to think, you'd have to be a bit old and a bit boring, as it were. But actually, I think there's more people who should be looking at exchange traded funds than I thought previously, who perhaps shouldn't be looking at individual stocks because they're not suited to it. They don't know they're not suited to it. Until he pointed out that actually maybe you're not suited to it. Okay. What to expect? 40% return in 12 months. The ones we're looking for these. The ultra high net worth buy recommendations from the big banks. All right. What they tell their richest clients. Don't forget also, look at my Telegram channel. If you're on TikTok, it's alpeshpatel.com/links. Where you get invites to that parliamentary event. Was free and open to people. I do that 4 times a year. And then for some of my clients, sadly, Simon had already gone. He was there. Some of my clients who can make it, I take them out. So that's me with 1, 2, 3, 4. Well, the 5th one's gone from the Great Investment Training. We take them out. That time, nothing salubrious. It was just Pizza Express, actually. Bank of America Corporation. We should be looking at that, just continuing upwards. I mean, So I'm just giving you the market update now. Okay, Netflix. Well, that's the most bullish case if that trend continues, but it is slightly overbought, although it's an 8. So it can't be a special situation, which means if you want to do it as an investment in a non-special capacity, then that'd be a stop loss where that red line is. Walmart, similar kind of analysis. It's an 8, but it's overbought. So if you want to do it as a non-special situation, most special situations are 7, 8, 9, or 10. And where the MACD's at that level, it's not now. It's already at that level. So it's gone up that much, which means you'd have to do it as non-special, which means probably put a stop loss down there. And that's the projection you're looking at. Okay. Don't forget, you can follow me on LinkedIn. Don't connect with me unless I know you and have met you, because I'm not allowed to connect with you not because of my wife, but because of my government work, if I've not met you. Okay, I'm going to answer your questions in just a second. This is still not going away. UK fund manager blames lack of exposure to tech and fossil fuel stocks, as well as broader malaise in the UK market. Well, he said it. He bloody said it. Their own words from the mouths of fund managers. Shall ye know the truth, and the truth shall set you free. There you go. Said it himself. These are others. Scottish Mortgage Investment Trust, 50% loss. I don't trust any of them. And I get proven right time and time again. 50% your pension gone. Blue whale, 26% in 1 year, and your workplace pension is in it. So one of the things I mentioned was hedge funds we also look at. When we're looking, we don't just do this. What we'll do is we'll go through this and we'll say, well, wait a minute, there's a load of stocks we've got which are all green, let's say. Are there any hedge fund managers who've been generating 40% per annum for the last 3 years, like this one, he's generating 52% per annum, and do they hold any of the stocks which are in our filtered category? If they do, that's a good tiebreaker. So let's say Christopher had a stock which was also all green for us, then we'd say, well, let's go with that one then. So we don't presume a monopoly on our own brain power. That was, that's what this is. Where do I get all this from? Well, everything that I told you, the analysis, the data, the reasoning behind value, growth, income, cash flow, Kroki, Sortino, Alpha, I've published in my Financial Times columns, okay, and in my books, so you know. And I did in 1999, yeah, believe it or not, I look like this once. Oops, like that guy. 1999, I wrote The Winning Ways of Uncle Sam. Boy, am I right. I'm selling all my UK holdings. There it is. I've been switching virtually all of my long-term holdings from UK into US. Alpeshpatel, 1999. Exactly 25 years later to the month, UK pension fund allocations of British stocks hit historic lows. I'm not being unpatriotic. What I'm saying is I want British people to own American assets in their SIPs and pensions and bring the profits to the UK and spend it in Britain. Let the Americans work for you for a change. Okay, that's all it is. Nothing wrong with that. And please don't talk to me about bloody currency risk. I show you a 50% gain on a stock and you say, well, what if the currency moves 1%? I'll pay by the way. Okay, and if that worries you, then you shouldn't do it. Okay, if it worries you, if 1% currency move worries you, you shouldn't do it. You should actually, like I said, take life easier. Blue whale, 27.6%. These are pension fund managers. Your workplace pension is in these. Ask your workplace pension. Okay, active fund managers. This is not recent. 2011, same thing. Just absolutely bloody awful. British and American fund managers. I don't know how to decide what to buy. This is the major problems people face. So I'm going to make it easier for you. Somebody said to me, one of my clients, new clients today said, but this just seems so simple. I said, well, it's like an iPhone. An iPhone seems very simple, but it also is incredibly complicated. A car is simple, but it's complicated. It's simple at the point of use. Yeah, all green. But it's incredibly complicated because value growth. So I then showed him the Sortino ratio with the standard deviations and the subtraction of the price and from the mean. And he thought, oh, okay, yeah, I see this is complicated. Because I simplify it to say, well, we just need all these to be green. A bit like the iPhone. The whole point of it is supposed to simplify, not ever to be like this numpty. Okay? If it's all green, it fits. Then all you've got to do is based on your risk profile. Here's a little trick. And in fact, I might do this. I might say if your risk appetite is between 1 and 3, like those scores on psychology tests, you should only pick stocks with volatility under 10%. If your risk appetite is, say, 4 to 7, then you can go up to 20%. If it's 8, 9, or 10, then you can pick stocks above 20%. Okay? Or you could have, if you do have a 25% one, you can mix it with a 19 to average down. Right? Like I said, one tactic then can be, if you find ones which are all green, let me just show you. Let's say you've got something like this. Okay, so these are all green. All right. Yeah, I know. I appreciate I'm not showing you the names because my clients would go mental. So these are all green, right? Let's say I show you those which are all green. Then we can tie break by looking at which hedge funds are generating 40% per annum, as I said. Okay. Okay, look at those. This isn't up to date, so don't just dive into this, all right? Now, he happens to own these previously, and we can say, well, okay, let's see if any of those meet our requirements, right? So that's one way in which we can have a tie break. Another way we could look at the biggest managers in the world, like Warren Buffett, Bill Gates, and so on, and see what do they hold. I have bought United Health, just so you know. Okay, I do own these. It's no secret I own these, and I'm going to continue holding them. All right, that should be no secret to anybody on there, right? JP Morgan, you already know because I've told you before. I own JP Morgan as well, and there's a Goldman Sachs in there somewhere. Okay, so the important factors are very simple. I just look at that to scan the markets. It's not just US, UK, are in there as well. It's just that there's fewer opportunities because there's fewer companies in the UK than there are in the US. All right. I will answer the questions. Don't worry. I've got a whole bunch of questions to answer as well. Monitor infrequently because you don't need to. Exit rule is 12 months if it drops 25% from entry. That's the simple version. Okay. Value growth, income, momentum, statistic, 20 to those. You might have some funds, or you might only have funds based on your risk appetite. We can walk you through that. Biggest mistakes I've observed people make. Mistake number one, they don't do the analysis. They don't actually look at these factors. So they're investing blind, which means they're gambling and they're relying on luck. Okay? They don't allow for these factors. These are the most important factors. Don't take my word for it. Look at the academic literature. Look at common sense, which moves stock prices. Doesn't mean that if you look at all that, you're guaranteed to make money. But if you don't look at those at all, then you're relying more on the space of luck. And the more you allow luck into it, the more you're likely to be screwed. Not knowing when to hold and when to sell. Essentially, I think I should get the Nobel Prize in economics for this. Sorry, it sounds really arrogant, but I think this is just brilliant. And I've written about it in my books for 25 odd years. I didn't used to call it mummy bear, baby bear, daddy bear. Basically, if when the market falls, it's a 3, which is a baby bear, i.e. the MACD monthly is rising, you can ignore it. If it's a mummy bear, don't panic, i.e. the MACD is falling, you can still ignore it. If it's a daddy bear, get the F out of there. If it's an index like the S&P 500. What's a daddy bear? Overbought, high, sharply declining, MACD falls through its own moving average. That's a daddy bear. There are about 1 or 2 daddy bears every 7 years. There are multiple mummy bears in a year, maybe 2 in a year. And there are maybe 4 baby bears at least in a typical year. All right. So lots of kids can be ignored. Lots of wives can be ignored. But when daddy gets home, don't ignore him. Now, another way of looking at this is, I'll answer your question, Joa, everyone else. Oh, well, Perish, I think you're answering quite a few. Thank you very much, my friend. I appreciate it. Generac and these. Now, when we have a particularly good year, there is no guarantee of that ever. I don't generate good years. My spreadsheets don't generate good years. This is where people get irrational. My spreadsheets do not cause the market to move up. I cannot find companies if they do not exist. In a falling market like 2022, we had to hold cash most of the year. Thank God, because the market fell 25%. We didn't know it was going to be a falling year. We just looked at January's list and said, there's nothing in there we want to buy. Let's wait till February. February said, still nothing. March, still nothing. April, still nothing. May, still nothing, right? But in a good year, and this is an exceptional example, which might never, ever happen again, just assume it never will. Okay, what happened? Well, these were some of the great outliers. Did I know these were going to go up that much? No, because if I knew that, I would have put all my money and then some in just one company, wouldn't I? Of course not. Well, wait a minute. If that went up 208%, how come you only got 54? Because some stocks still went down. People find that shocking. They can't get their head around it because what they think I'm doing is giving them some kind of newsletter insider trading tip sheet, which means every stock goes up. Nope. Which means we know one company to buy, and that, nope. We know exactly how much is going up. Nope. 12 months, 20 companies, a selection. If you joined in January, it would be a different 22 if you joined in July, for instance. Opened your portfolio different times, different results. And assume this will never happen again. If there's a tailwind, you get blowout like we've got at the moment. Last year, like we're going to get for the next 2 years at least. I still, from a investing perspective, from a professional perspective, I'm over the moon that Trump's won. From a what it means for women, what it means for minorities, etc., what it means. My thesis, I used to work in the US Congress, by the way, in 1994. My thesis for my degree at the time was on abortion and its implications during election cycles. So I'm a bit up to speed on this and what it means to them. So I'm not talking social. I'm putting that to one side for a second. I'm just talking what it means as an investor. Okay. And you might think that's completely immoral, but I would respect and understand why you would think that. Anyway, 54%, 12 months, might never happen again. If there's a tailwind, you get blowout returns. Now, let's say that only happens in the next 2 years, and after that, you just get average returns. Well, it means your pension's gone from here to up here, and then it's going to move at average levels at that higher level. Fine. Okay, mistake number 4, people make, not having an exit plan. 12 months, 25% drop. Okay, that's your exit. Looking at too few stocks. So if you look from a small database, you're screwed because you're not looking at enough. And that's a common mistake. Paying more to fund managers. Honestly, with Trump in, there's less reason to use a bloody fund manager than there's ever been, because the obvious freaking companies are the ones which are going to be doing stupidly well, the way it looks like it. And you're paying 10% to give it to an idiot who's not going to go into those companies, and they're not going to go into those companies because either they don't have the mandate to invest in them, or they've been told you've got to invest in at least 100 companies. So you can only put 1% of your capital or 2% in any individual stock. Whereas as a private investor, you might put 5% of your capital in. That still means you've got 20 stocks. 5 times 20 is 100. Okay. You might go as high as, well, for my quality 5, I go as high as 5%. Sorry, 15%, so 3 times 5 into any one. Like Microsoft, I might have up to 15% in them. Do you see? Depending on whether it's January 2023, for instance. And don't think, oh, I missed the boats, I might as well not bother starting now. Well, actually, I think the boats just come back in store. But we'll keep looking. What annoys me is when I get this. I mean, Legal and General, private by employer, the information is shocking, 20% growth between 2012 and 2022. I've been following your weekly report. This is it. I've invested very limited funds, but I've seen returns around 20%. I didn't generate those. I just simply opened up their eyes to the opportunities. And it was the people working, and it was the market conditions which generated them. So is 40% realistic? Given that I've mentioned it with hedge funds, given that I've mentioned it with the banks, given that I mentioned the trajectory, when is it realistic? Well, under limited circumstances, there has to be markets going up, which 5 years out of 7 they do. If they never go up ever again, you'll never get any positive return ever again, because the past is not a guarantee of the future, and the future might, for now, never be positive ever again. Okay. Also, I think you've got to use the cash return on capital invested as one of your filters. Really helps. Well, no, you don't have to, but it really helps. And Goldman Sachs shows that 30%. Hold for 12 months, then reevaluate. If it drops 25%, get the hell out of there. And you want to tick those other boxes. So to give you an example, what happened to us last year, okay, that was the return. That might never happen ever again. Although, actually, with Trump in, I think that's more likely to happen again. So I've been saying up till now, that might never happen again. I'm now saying, well, that may well happen again very soon. Over the next 2 years, I think one of those 2 years could be another 80% year on the pension. And why? Well, because these were the stocks. Now, notice this. We had a loser. Even in a winning year, one of the greatest years, actually one of the best years we've had, if not the best year we ever had last year, right? We had a losing stock. But wait a minute, Alpesh, you had the same selection criteria. How come there's such a big variance between Nvidia and Tapestry? I'm sorry, there is. It's why we don't pick just one stock, because we might have ended up with Tapestry and not Nvidia if we pick just one stock. It's why Warren Buffett doesn't. Why Bill Gates has more than one stock, and their portfolios have more. Okay. Well, wait a minute, Alpesh, you picked obvious names. Biggest mistake people make. They don't go for names that they've heard of because they think I've heard of it, therefore I'm not going to go for it. Well, wait a minute. That's not one of the Excel cells. I've seen it time and again. Yeah, well, no, you pick the big ones. I've heard of them. I don't want them. I want ones I've not heard of. Okay, fine. Go for Tapestry then. That's why we do not care if they're ones we've heard of or not heard of. People have a bias against name recognition. It's shocking. Okay, now, this might never, ever happen again. Although now with Trump, like I said, I think it's more likely because he's going to fuel asset price rises, not least because he's got a massive conflict of interest. He owns Truth Social. He has a listed company valued in the billions. If he elevates the stock market and jet fuels it and makes, look, he's thinking to himself, why the hell am I not a trillionaire? Okay, come on, you know he's thinking that. And he's now got a listed company, Truth Social. I think he owns 50% of it. He's got a massive conflict of interest with the stock market. He wants that baby to rise. And you know he's the kind of nut job who will do anything required to make that thing rise. He's looking at himself, screw the presidency, been there, done that. I want another 10 billion. At least I want that company making me 20 billion, 30 billion. Why not? Yeah, I'm the president. He wants to go down in history. He's gone down in history. He's already gone down in history. All the things that he wanted that everybody laughed at him for. You're a one-term president, you're a loser, you're one of the worst. Now it looks like, hey, shit, this guy's going to break a few records. The monster's been fed. The ego has been fed. It's going to be nuts. Strap in and put your helmet on. But yeah, I think that's more likely now than it to repeat itself. So is the downside volatility as well. Okay, so be careful. Assume you plan to invest over 10 years. Let's say you do 20%. Some years more, some years less. Let's say you got 100K. So you add 1.5K. Then you should be $1 million over 10 years. You got to judge it over 10 years, not over 10 minutes. All right, 0 there. That's what would happen with those returns. That's your contributions. Of course, it doesn't go like that. What happens is it goes like this, then like that, then like that, then like this, then like that. That's actually the reality of what would actually happen. At any given time, you might look at it and go, oh, yay, I'm doing so well. I'm doing so well. Oh, I'm doing so well. But the whole point of it, by getting those returns, is that by year 9, you're getting over 100 grand in passive income a year. Okay, 100 into $1 million. That's the plan. That's the journey. Okay, that one doesn't matter. And the reason I say this is not just because of this, not just because you can follow the performances on social media and winning this and winning a Bloomberg competition, Channel 4 Show Me the Money competition as top performer as well. It's not just because of that. It's because, well, actually, the underlying hypothesis is based on Nobel Prize winning literature I put in the book. Are they undervalued companies which are growing with dividend yields? There are other ways to pick stocks. You could just pick, you know, what's measured and what's mentioned on Trump's tweet feeds if you want, or Reddit if you want, or Wall Street Bets. It's up to you. Okay. What worries me is people think they can't do it, and only numpties like this idiot can do it, who lost billions. Because he's good at marketing. He's not very good at performing. Okay? And those who are good at performing don't get billions like he did. Still waiting. Okay. 20 to 40 is probably the number of stocks you want, because then you've eradicated specific company risk. Okay? Let me run through this. Not an endorsement from Barclays, just saying, if you want to download the book, wait a minute. Where's that? Oh, it's up here. If you want to download the book, oh, thank you, Ravi. That's very kind of you, my friend. I'm going to broadcast that to the room. Thank you, Ravi. If you want to download the book, I'm going to make that available now. You should have a bunch of, the book should be up there as well. Okay. This is the croaky slide. Don't get fixated on it, but basically it's from Goldman Sachs Research, Quantum Database. I take research from other places. I published it in my books anyway, so it's not like I'm doing it afresh. And the reason I like cash return on capital invested is because 30% per annum is what baskets of stocks achieve, which are in the top 25% by cash return on capital invested. Not every year. Look, in a financial crisis, nobody gets that. But 30% per annum is why I want to tick that box. Not saying it's guaranteed, not saying it's going to happen every year. For those looking for guarantees, please go away. You're nuts if you think the stock market gives you guarantees. But I need that box ticked, so that's why I look at Croaky, and I stole it from them because they're cleverer than me and can do more research than me and have the capacity to do more research than me. But I do believe that taking their research and giving it, being a sort of Robin Hood with intelligence, okay? This is a typical bad portfolio that I get given. This is from a while ago now. You know, tons of shares, each one of those with 50 to 100 stocks in it, piss poor performance, sadly. And then they'll come to me and say, look, I'm really worried. I've got a few years to retirement and the performance is really, really bad. Okay, what do we do? And we try and give them a very simple process by which they get the data and we teach them. So education, information, so that they can select better, and we handhold them forever. Brewing Dolphins, another one I get a lot of criticisms about. St. James's Place is the most popular list of complaints I get. Stocks spread over 1,000 different companies. Scattergun effect is what they do. Fisher Investments is another one. Go into our fund. It's a marketing machine with salesmen. Okay, the business model for the fund management industry, salesmen and distributors get kickbacks for selling it to fund managers. Their job is to see you as prey and get you to give them money. All right. And it's pretty shocking, and they perform pretty poorly. I want to show you something now, which are my personal ambitions, okay, which center around all of this. That's the Holy Grail, the secret vault, as it were. These are 4 women who happen to work for me. They happen to be women. I didn't interview or hire them myself. My team hired them for me. Susan's now at Wells Fargo. Kirsty's now a pensions lawyer. Naomi is an investment fund manager. She joined me straight out of university and worked for me for 2 years. If you look at her SEC filing, she always mentions she worked for me for 2 years before she went on to fund management directly. Kanira's in venture capital, I saw the other week. Okay, we're good at teaching people. We can teach anybody to drive. We can teach anybody to invest. I can teach you to drive. I can teach you to invest. Okay. People ask us, can you do it for me? And we say, well, actually, yeah. And we realize we're really popular, but we don't want to do it for you. We want you to do it. If we give you all the data, in 7 minutes, you can set up a pension and find the right stocks, because we've done all the hard work and given you all the data and the know-how. 1 hour lesson from us, which continues for life if you want to. You just have access to me for life. I'll say that again. I know people find that hard to believe, access to me for life. Then when we got all this from hedge fund managers, Merrill Lynch, American Express, Financial Times, Coutts Wealth Management, I thought, BBC, you know what? This is something which could be $1 billion Donald Trump-sized company. No, I'm not an egomaniac like him. When we got these amazing reviews as well, we thought, you know what? We could float this. We could have this as a separate company in asset management, different to a typical asset management company. I'm going to answer your questions in just a second. And I take people on. I want to take 350, it used to be 250, but I can manage 250 in groups of 10. Then I want to get to venture capitalists. My wife works in the venture capital industry. Go to venture capitalists, get them to fund it, and then eventually IPO it, make it global. We've already got clients from Canada, America, South Africa, Australia, India, Dubai, Qatar, UK, throughout Europe. Take them in batches of 10 to showcase and prove it can be done. Okay. And I mentor them directly. I have a whole team, by the way. People think it's just me. It's not. I have a data team, a company, a data team, a graphics team. So were I to fall under a cliff, don't worry. Everything that I would teach those people who join is actually recorded. So they'd actually know what to look for. And the data gets updated by the company anyway, because it comes from the stock exchanges. So that wouldn't matter. And the company continues existing. Basically, if the president gets shot, then the vice president takes over and we have a line of succession. So we thought, well, we don't want to charge. We want to be better than the fund management industry. We want you to manage your own funds. Like Uber doesn't own cars, Airbnb doesn't own properties. We don't want to own your assets. You manage your own funds. We'll give you the data. You have access to me, get the data, get the education, and you have lifetime access to me, but you don't have to pay a subscription, no weekly, monthly, annual fees at all. And people said, okay, fine. And what people actually want is the database and access to me. Some say, I don't want access to you. I don't need it. I just want the database. So fine, same thing. Okay. Some say, no, I don't want a subscription. It's not a subscription. It's a one-off. Well, what if I want it as a subscription? Fine. It's the same price as the one-off. Okay. I want to do that because we think St. James's Place shouldn't exist. We think it's an inefficient survivor in the market because somebody better hasn't come along. We think this is better, where you cut out the IFA and the wealth manager and the fund manager, and you own the stocks that you want based on your appetite, bespoke to you. They don't give you anything bespoke. What they do is they give you the same funds they give a million other people. It's commoditized. You're a conveyor belt, all right? They have a garbage conveyor belt, and they treat you like garbage, and they just put you through it. So we don't think they should exist, and that's the idea. Those returns might never happen, 55% in a year. But the no-brainer decision should be, if you've got a 500,000 SIP and it goes up 20% in a year, you improve it by even 10%, then you've made 50K in 1 year, let alone for the rest of your life if you get another 10% improvement. So if I can improve with all this education your performance by 10%, then you've made 50K on a 500K pension. And that then compounds going forward anyway. That's what I do. That's what I want to do. I want to float the company eventually. Now, in the hedge fund industry, you don't float. You don't tend to float hedge funds, sadly. But in this, you can. It becomes a technology company, becomes an alternative asset management company. And I want to challenge St. James's Place. I mean, they're the target on the back. You need somebody to have a target on the back for you to do it. So that's what I want people to do. I'm going to answer your questions while I put that up there. As well. Now, there's quite a few. Rod, new to Alpesh, a year into retirement and ditching SUV. I know. Looking forward to a better future. Thanks to you and your cause. Thank you, Rod. My pleasure. And hopefully the education will help. People want to buy the next recognized company. Joining it. Thank you very much, Ravi. Joining us, life-changing decision. It's been over 4 years, and Alpesh is an incredible mentor. Thank you. Well, I try and meet you regularly as well, my friend. I know I've got an email from you that I've got to reply. Jeff, why has Warren Buffett been selling Apple stock for cash 3 times this year for billions? I think before the Trump thing, it was the same reason I sold Meta. It was a rebalancing. He'd made so much money, and that's one reason. I think the other reason, well, the 2 obvious reasons. One is rebalancing. There's only 2 reasons you sell something. Rebalancing, and you've got a better place to put the money with better returns. Doesn't mean you think that company is necessarily bad. He doesn't. Otherwise, he'd have sold all of it, which he hasn't. Okay, so I think there's a rebalance element, and I think he's got better alternatives elsewhere. Well, I've got better alternatives than Apple elsewhere. What are they? Some of the ones I've mentioned. But that doesn't mean I sell my Apple, which I continue holding. I still want to have it because I don't just pick one stock. But I don't think it's a negative on it, which is what people have overread. Andrew, don't people buy in favor of name recognition, not against it? With funds, they do. Well, actually, in a way, Andrew, you're right. You've got I should treat it more like a barbell. You've got one extreme, which will only go for name recognition. And then you've got the other extreme, which will be repulsed by it. I guess I was talking about the one which are repulsed by name recognition. Certainly with fund managers, they go for name recognition. You're right, Andrew, actually. Paresh, Gavin, Fab, well done for having patience. Gavin, geez, just seen Geo was up 37% today, held since February without too much happening. Prime example of patience. Gavin, I'm afraid that's why I say 12 months. You know, people get shocked how often that is actually the case. So going through that, Paresh, good idea. Longer due call with Alpesh. Yeah, Deepak, absolutely. So on the basis of momentum being overbought, etc., should I consider selling Microsoft? No, remember it's one of the quality 5. Wait for my is it a daddy bear? That's the rule for the quality 5, and I'll be doing my weekly update tonight. Or given today's events, do I make an exception? Wait, we don't tend to make exceptions. Just wait for my weekly update. Sushila, that was my grandmother's number. Any views on Quavo? It tanked recently. I don't. I haven't looked at it, I'm afraid. Sorry. Paresh, not 100% will go up every year. Deepak, book call with Alpesh. Point is, Lily, not move with the rest of the market. Yeah, so our strategy isn't laggards or whatever else. There's a specific strategy. 1% fee for doing bugger all charge by each of IFA trustees and actual pay. I know, Mark. I know. Tools. Okay, would I buy Tesla today if you have spare cash? I just showed you my analysis of Tesla and what the investment structure I do would be. So the answer to your question is yes, but on the investments, but it's not would I buy it. That's actually the worst thing you could say to somebody, because what you've done is give them half an answer. You've got to know what's the duration, 12 months, I said. Okay, because guess what? You could buy it, F it up, and get out tomorrow, and then it skyrockets because you didn't know how long to hold it for. 12 months, or it hits the target that I specified in the chart earlier. And oh, sorry. So you go to alpeshpatel.com/share. Somebody just asked me about that, which is where's it gone? It's this website. Okay, alpeshpatel.com/shares. If you can't get on, because often we get a lot of people on at the same time, it's alpeshpatel.com/shares too. If you'd like a tour of the whole program, just email Paresh. He's on the call on this webinar. What was I talking about? Would you? With that. So it's duration, the target that I mentioned, and the stop loss, and making sure you don't put so much in that you'd lose more than a percentage. You might go for 2. You might say, I'm willing to risk 3. But then at least that's up to you. I'm a bit right-wing with investing. In other words, I want you to be in charge and know full well with full transparency what you're in charge of. Okay. Thought on Buffett selling half his holdings at Apple and sitting on Mountain of Cash. Well, Mountain of Cash, let me answer that in 2 parts. The Apple part I've already answered. The Mountain of Cash is because, like me, he can't find. We'll see what happens on Friday once we update the database again and things, and I do the updates because now it's slightly different after Trump. It's because he can't find the opportunities, then he'll sit on cash. Please learn from that. Please learn from that. Don't say, oh, I've got some cash, I was going to shove it in the market. No, he's good because he will wait and wait and wait. Trump is just too unpredictable. From a game theory perspective, that's very good for world peace, believe it or not, to base any investment on what might or might not do. Fundamentals still rule. Fair enough. Paresh, Tesla is right. Yep, I think we've done that. Let me go down. Angus, have a call with me and I'll show you. It'll make it no difference. Would The Great Investment Program be worth joining if one's employment contract restricts them from investing freely in individual companies. Yeah, we've got a few people who can only do ETFs. And so what we do is we're a hell of a lot on ETFs. So we have an ETF database of 10,000 exchange traded funds. So Angus, actually, we've got a few people who are in banking, for instance, or their spouses are in banking. So what happens there is they can't invest in individual stocks. For instance, spouse at Barclays, spouse at Deutsche Bank, to give two examples. And so they do exchange traded funds. We've got a database of 6,000 or 9,000 ETFs, and then we narrow it down just as we do for stocks. And then I do commentaries on those. They get the, and we just do it exactly the same way. So instead of picking from 10,000 stocks, they're picking from 6,000 ETFs. And the ETF returns are easily comparable. To be honest, I think they're a little bit easier because the volatility is less because they're funds. And I'm starting to think, I'm going to discuss this with Paresh tonight. I think we should emphasize the ETF part a bit more. Because stocks are sexy, ETFs are considered non-sexy, but you can get less volatility and a bigger return. I think you're getting more optimal returns. If you want to see 2020 returns, they're there. 2022, we have to be in cash most of the year. If you want to see 2023, they're there. 2024, they're in the webinar. So that's those. If you want to see earlier than that, Paresh can give you a tour and show you everything back to 2004, okay, from when the approach was formalized and monitored independently of us, okay, by a third party. And the third party is a Financial Times award-winning company, by the way. And Paresh can give you a tour of that if you wish. So whilst there's all this education, so if I fall under a bus, you've got everything you need and you've got Paresh anyway. You've actually don't need to look at this because it's like giving you a car manual. You just need me to give you a few driving lessons. Okay, so we give you all this extra stuff, but you don't actually need it. But some of my students want it. They want to know it's there. A bit like the church. People don't go, but they like to know it's there. Yes. Have to declare spouse independence. Exactly, Angus. Now, fully understand. Do speak to Paresh. He's got the email and he can do that. Will Trump's delay the S&P, Daddy Bear? That's the point, Herschel. That's what I said at the beginning. You might have missed the early part. Yeah, I think it will. I think it's going to definitely delay the Daddy Bear. But when it comes, it might be steeper. But let's not over-predict right now. Underperformance, you've said, is the major issue you have with IFAs. Well, imagine you could pick your individual stocks and their data is given to you. So, and if you were really worried about underperformance, we'd actually just show you how to have, I have 3 times leverage S&P 500. Oh, but can you beat the S&P? Yeah, I've got 3 times leverage S&P. Well, it's cheating. So what? I've got the return. Cry me a river. So there are ways of definitely ensuring you can beat the market. And actually, the Daddy Bear rule, you'd be shocked how often it works with ETFs and the Quality 5. And what I call the Quality 5 Plus, which includes Novo Nordisk, Eli Lilly, and NVIDIA, as well as the 2Ms and the 3As, Meta, Microsoft, Apple, Amazon, Alphabet. It just works a treat with those. Not with every stock, but it works a treat with those and with ETFs, which means you can even make this really simple for people if you wish. To the extent I had somebody today saying, this seems too simple. I said, yeah, well, it's like an Apple iPhone. It's meant to seem simple because the complexity is hidden behind the database, and I can make it complex for you. And then I showed him, that's the website. And then I showed him the formula for Sortino, and I think he almost had a heart attack, poor guy. Sylvain, maybe call. Hi, Sylvain. It's the same or similar subscription that was offered about 10 years ago. No, it didn't exist 10 years ago. I think you're thinking about the trading thing, which I've still got the software for trading, but trading's different. So I have 2 things, trading, investing. Investing is holding for 12 months. Trading is a week, 2 weeks, 3 weeks. The trading one still exists. I've got that. The algorithms, because my background is actually in trading through hedge funds. Investing is what I do now as an older man, even though I've written about it for the last 25 years. But trading is what I set up the hedge fund in. Yes. World transfer. Okay, good. I'll just put your email address in there for anybody who wants a tour and wants to speak to you, because I think it's quite a few questions. I'm going to switch off in a second and they might not have your email address. So just put your email in there as well, so people can see it. Okay, yeah, well, that's it. You can just directly put a tour with Paresh. I'll hold a couple of places. So I'll block this so that we've had quite a few sign-ups. So I'll just make sure we block it before the rest take up all 10 rows. So if those who want a tour, just put your name down in the comments or your email address in the comments so Paresh reaches out to you. Otherwise, all the places are going to go, and then that's it. Because I only mentor in batches, because obviously I want to do a good quality job of mentoring, so I can't take on 100 or something ridiculous at one time. I think with the program, it's better to have a fund manager, IFA, DOI, or robo-advisor. Remember, it's not like a newsletter where you've got a conflict of interest and you're paying a subscription and they've got to give you stuff even if it's rubbish because you've paid a subscription. I have no conflict of interest with you. I'm not a brokerage. I'm not a fund manager saying to you, please give me your money and keep paying me your fees. You're not paying me fees. It's a one-off. That's why it's a one-off. I've spoken to one or two venture capitalists whose help I'm asking in how to make the model such that it is easier for people to get onto it with, well, have a subscription model, but without it being subscription, if you see what I mean. But anyway, it's a one-off at the moment. And the reason for that, people say they love the aspects of it, that they've got access to me for life and that they know what the full-time cost is for the rest of their lives. Okay, so they love that as well. Sylvain just messaged Paresh and he'll give you the access from before. If you've lost the access to pipspredator, he'll sort of resend that. Oh, there we go. Get a tour. Paresh can give you a tour. He was a floor trader in Japanese bonds. That's what that means. Kite Securities launched a hedge fund, Marble Bar, and then these are the books we've co-authored together. That's got all his strategies from the hedge fund he's put in there in that book. Oh, actually, and in this. Actually, wait a minute. I think you've put the strategies in all three, Paresh, possibly. But yeah, anyway, they're in those books as well. Now, I'm going to get going. This is why we're not like a tip sheet or a newsletter. Sometimes people get confused and they think, oh, is it like a tip? No. Tip sheets don't look at your whole portfolio for you. They don't provide ongoing education. They don't give weekly live market updates. They don't give you hedge fund selections targeting 40%, or bank performances targeting 40%, building portfolios. They don't have Nobel Prize winning research behind it, access to the data underlying what they're giving. They just give you the name and that's it. Okay, and we don't have conflicts of interest. Okay. Okay, thanks, Paresh. Day trading in the first two books. Understood. Thank you very much. Very true. Perfect. Okay, guys, I'm going to go. If you go onto there, if you got any other questions, just email me or email Paresh. And yes, we do have installments, hence that. You only pay VAT if you're in the UK. And we also have a discount for those who are on this. The prices are going up again. You'll know they've gone up. They're going up again. Imminently. The team are just working out changing all of this and making the website ready for the new price point. If you're on the webinar, that's the coupon code OCT6 for the 40% webinar discount. Okay. And any other questions, let me know. Have a look at this campaign for 1 million, which is my campaign to teach 1 million people through webinars, through my books, through articles, through online free material. 1 million people how to add an extra 1 million to their pensions across their lifetimes, because 1 million times 1 million is 1 trillion. Okay, so have a look at that. I've overshot. I'm going to get going. Okay, Paresh, I'm going to hold off a couple of places in case anybody wants a tour and is on the fence, if they let you know. Otherwise, I will let those go because we've got a lot of interest. I guess it's the whole Trump thing as well, why there's a lot of interest, and we're coming up to year end. So we usually find during November and December, people want to sort themselves out for January, so they dive in, which is a good sort of like New Year's resolution sort of kind of thing, and they get involved. So that's where we are at the moment. Thank you all very much. Yeah, we're going to go from that to I will email you all shortly who signed up. So not long to go now. So just wait for my emails on that. Thank you very much for being in the webinar. And those of you on TikTok, thank you very much. Have a look at that. Have I missed anything? I'm just going to check my website. No, don't forget also YouTube. You can have a look at a bunch of videos that I've done as well on there. There's a whole bunch of videos here. And I do the weekly updates on there. And you can find that on alpeshpatel.com/links to that. Thank you very much. I hope you enjoyed it. Sorry, I've taken more of your time than I intended because I didn't think or intend to go on this long. And if I can find this, then I will. Oops. Okay, that's that. Okay, everyone. I think that's it. Thank you very much. I think there's a few other questions I've got. It is just a one-off. I've got some private Q&A on there. I will email you. I'm happy to save a spot for you. No problem. I will email you separately. Thank you all very much indeed.